All right, let's dive right into this explainer. If you've spent even 5 minutes looking at financial markets, you know exactly what I'm talking about. Those little red and green candlesticks decorating literally every chart out there. But today, we're leaving behind the emotional, gut-feeling chart reading. We're moving into a strictly quantitative, data-backed reality. We are going to strip away the myths and figure out what actually works in the real world.
Let's kick things off by challenging some of that conventional wisdom, stuff that some quants jokingly call chart astrology. Because honestly, have you ever noticed how those perfect textbook candlestick patterns just fail when you try them with real money? I mean, sure, it's super easy to look back at a historical chart and spot a flawless reversal, but trading live, totally different beast. We really need to ask ourselves, are our trades grounded in a true statistical edge, or are we just suffering from massive hindsight bias?
So, here's our roadmap for building a more scientific approach today. We're going to cover the candlestick prediction myth, the top patterns backed by actual data, timeframes and market noise, factoring in tick volume, some totally new academic trading models, and finally, why you need systems over sentiment. Starting off with Section 1, the candlestick prediction myth, separating fact from fiction.
Look, before we get into the complex patterns, we really got to strip away the magic. A candlestick isn't a crystal ball, right? It's simply a visual representation of OHLC data: open, high, low, and close. That's it. It's just raw data summarizing a pretty messy fight between buyers and sellers, telling us explicitly who won that specific session.
And that basic reality right there perfectly illustrates why academic studies show such completely mixed results when traders rely purely on what they think they see. Let's be real. Most of the trading education out there relies on heavily cherry-picked examples. You know the ones. They show you the 3 times a pattern worked perfectly, but conveniently ignore the 70 times it tanked. It creates this immense, dangerous hindsight bias. Throw in subjective definitions like, hey, what exactly counts as a long candle anyway, or a strong trend, plus a total lack of systematic out-of-sample testing, and you basically have a recipe for losing money. Bottom line, if your rules aren't strict enough for a computer to test them, they are way too subjective to trade reliably.
Moving on to Section 2, top patterns by the data, what 30 years of S&P 500 history actually reveals.
Now this is where it gets really interesting. When quants systematically tested 75 different patterns on the S&P 500 all the way back to 1993, the math threw some massive surprises our way. The bearish engulfing pattern, it actually took the top spot for overall compound annual return at 5.37. The 3 inside up pattern boasted a profit factor of 2.50, meaning for every dollar you lost, you made $2.50. And the dark cloud cover showed an insanely high win rate of 71.52% when held for 19 days. But wait a second, bearish engulfing, dark cloud cover, aren't those supposed to mean the market is about to crash?
Well, here's the absolute crucial point. In the stock market, a lot of traditional bearish patterns are actually incredibly effective as bullish mean reversion signals. Think about it. Stocks naturally want to drift upward over time, so when a severe bearish pattern hits, it very often means the selling is just totally exhausted, which sets up a highly profitable long side signal. The data also proved that win rates climb significantly when you hold for about 17 to 20 days. In fact, when quantitative researchers combined the top 5 patterns into a single strategy, they yielded a completely wild 74% win rate over 30 years. No way, right?
Which brings us to Section 3, time frames and market noise, because where you look matters just as much as what you see.
If you're out there trading a 5 to 15-minute chart, you are seeing literally hundreds of candlestick patterns a week. But comparing these short and long time frames, it becomes painfully clear why those short-term charts are just plagued by market noise. You've got algorithms and high-frequency bots creating frequent false signals left and right. That means short-term charts absolutely 100% require extra confirmation tools. Long-term daily or weekly charts, on the other hand, they offer unmatched clarity. They naturally filter out all that intraday noise and give you the highest reliability for spotting major trend changes. I honestly cannot stress this enough. Just stepping back to a daily time frame gives you a much cleaner, far more dependable view of market sentiment. Why? Because daily candlesticks reflect actual, psychological market opens and closes. That overnight pause in trading means the open and the close represent significant, calculated decisions made by millions of participants. It makes the daily chart highly reliable for trading those complex, multi-candle patterns, like the Rising 3 methods.
All right, Section 4, factoring in tick volume, measuring real market participation.
So, unlike traditional stock markets where you can see exactly how many shares changed hands, decentralized markets like Forex don't have a central exchange. Traditional volume data is just missing.
So what do? We use tick volume. This is a technical indicator that measures the frequency of price changes, or ticks, within a given period. Basically, it tells us how actively a price is bouncing around, which is hands down our absolute best proxy for gauging actual market momentum. Layering tick volume over your candlestick patterns is a brilliant way to confirm your trade setups. Let's say you see a breakout pattern and those tick volume bars are growing. Bam, that indicates heightened momentum and strong conviction behind the move. But if a trend is pushing higher and tick volume is shrinking, that's a huge warning sign of exhaustion. And crucially, divergence, like when price hits a new high but tick volume drops, strongly suggests a potential reversal is right around the corner. It is literally the perfect context filter.
Let's jump into Section 5, New Academic Trading Models. We're looking at the cutting edge of quantitative research here.
Take a look at this recent study from the International Journal for Multidisciplinary Research. Most of us, right, we wait for a candle to fully close before we make a move. But this study highlights a totally underutilized concept, analyzing early candlestick formation. The researchers actually found that the first 10% of a candle's formation, so say the first 6 hours of a daily candle or the first 6 minutes of an hourly one, can accurately predict its eventual momentum way before it even closes. I mean, that is a massive paradigm shift in how we can analyze price action in real time.
Meanwhile, another massive study dove deep into the 24-hour Forex markets. These researchers found that traditional patterns, like the classic doji, are actually highly unreliable for predicting Forex reversals. Go figure. So they developed and introduced a completely new, data-backed predictive shape. They called it the MIDM pattern. MIDM stands for Minimal Difference in Shadow for Directional Analytical Movement. And let me tell you, the results of this new pattern are absolutely staggering. Systematically tested across 38 million historical 1-minute Forex candles on the top 8 currency pairs, the MIDM pattern proved to be an astonishing 138 times more profitable than the traditional doji pattern. It pulled off a 6-to-2 win-to-loss ratio in real market simulations. It just goes to show when we actually let the data speak for itself, we can discover massive edges that the old textbooks completely missed.
Finally, Section 6, System over Sentiment. It's time to build your quantitative approach.
So, how do we pull all this together? You build a system. These 3 steps right here are your exact blueprint for graduating from that visual guesswork to a truly resilient quantitative strategy. Step 1, define your rules. You've got to strip away all subjectivity so a computer could actually understand your exact OHLC parameters. Step 2, add filters. A raw pattern alone just isn't enough. You must incorporate context, whether that's RSI, long-term moving averages, or that tick volume we talked about. And step 3, test with costs. You absolutely have to backtest the strategy while accounting for realistic slippage and commissions, because let me tell you, tiny transactional costs can instantly erase a small statistical edge. This quote from the research just perfectly sums up our entire journey today. The practical edge in candlestick trading usually comes from combining patterns with context filters and realistic execution assumptions, not from memorizing names and hoping. As the hard data proves, there is no single magic shape on a chart. But there's absolutely incredible, bankable power in a disciplined, context-aware framework. So, as we wrap up this explainer, I want to leave you with a direct challenge. When you open up your trading platform tomorrow morning, will you continue trusting those hindsight-biased, textbook chart examples, or will you build a quantified, systemized strategy actually tested by hard data? I'm going to leave you with that thought to challenge how you approach your very next chart analysis. Thanks so much for joining me on this deep dive